All right, everyone, let's dive into another back-tested scalping model that combines order blocks, a sequence of supply and demand zones, and the pump market maker model. Essentially, this model identifies key entry points in the middle of price runs. And here is how it works. First, the model detects the formation of an order block, obviously a strong smart money sign that the market is priming itself for a potential shift. The model then looks for an impulsive move triggered by the order block, initiating this way an expansion swing and confirming at the same time the market's short-term trend. After the exhaustion and reversal phase, the price's next key step is breaching the order block's base. This round trip move is essential because it confirms the formation of the supply zone, obviously depending on the market's direction. Here is also an illustration that I put together of the demand side. All right, with that part explained, let's move on and check out this pound greenback chart. But first, let me draw the range here. And as I always emphasize, establishing the range is really important because it basically provides us with a structured framework to identify key price levels and at the same time determine if the market is trending or consolidating. In other words, it helps us define the market's sentiment. So let's dive into the juicy details of this model. Now take a look at this FX chart and see how the market was in a strong, obviously upward trajectory here before the demand side got fully absorbed. That's when the reversal starts. But here's the catch. After we shift and decline, you can understand which specific price action pattern this model is hunting for. As I mentioned earlier, the first ingredient is spotting the formation of an order block. And we've got one forming right here following this retracement. However, and this is a big however, this particular order block ain't the one that we're looking for. Why is that, you'll ask? Well, because this model only works if the order block triggers an impulsive move that kickstarts an expansion swing. That is the first phase of this bearish model, confirming the start of a short-term trend. So while this order block up here might look tempting to you, it's not quite fitting the bill for what we need. You've got to look for that high probability order block that checks all the boxes and sets the stage for the real action to unfold. And that high probability order block is this one down here. And now, why do I think this order block is significant? Because I know this phase of the model, which again includes the sequence of order block and imbalance zone formation, this phase of the model, once phase 2, keep in mind, once phase 2 is complete, which I'll explain in a sec here, will give me the entry signal that I'm looking for. Why am I so sure phase 2 will happen? Well, because it's just inevitable. In phase 2, the price will exhaust and shift direction at some point, obviously, like it does here, and climb back up, breaking through the base of the supply zone before hitting the bearish order block. This move confirms a manipulative or engineered play by the market makers, signaling to shorts that it's time to start looking for trade entries at this level. And now, as the price pukes lower, and again, the zone's breach is your signal to enter the market short. So as the price pukes lower, first via this impulsive move, and then through a distribution segment. Now, and here, before we go any further, it's important to note that this decline occurred due to the formation of an order block and the subsequent impulsive move downwards. These are key elements that define a supply zone. This means we now have a supply zone sequence forming, which makes the model an ideal scalper. But getting back to what I was saying, as the price drops lower here, the rapid formation of such a large imbalance zone is clearly based on a pump market maker model, which means thanks to this spike, we now have an almost immediate and second great opportunity to enter the market short. This marks the third and last phase of the model. Now, why do I say immediate opportunity? This scalping model offers, in my view, an immediate entry because once the order block formation and impulsive expansion are identified, it validates, in my view, the dynamic as a new supply zone, just like the initial supply zone. With this sequence of supply zones confirmed, any move, let alone a spike towards the base of the second supply zone, signals a high probability short. In essence, the second bearish order block triggering an impulsive move establishes a pump market maker model aligning with the previous market maker engineered demand retracement over here. This supply zone confluence makes any breach of the zone's base an optimal shorting opportunity according to this model's logic. Obviously, at this point, the price becomes way more directionally driven to the downside, not only because, again, this level up here shows another supply zone forming, but also because the imbalance, if you apply to it the open, close, and equilibrium metrics, is overbought and clearly well above the balance level. This means that anywhere within this high would be your short fill. And separately here, let me quickly explain the pump market maker model for those new to trading. So there is this entity called a market maker, and their job is to basically keep trades flowing and provide liquidity. Now these guys can play some mind games with traders to make a buck, and here's how they do it. They start by pumping up the price of an asset, making it seem like there is this huge demand and not enough supply. Traders notice this and start thinking, well, man, I think I gotta get in on this before I miss the boat. So obviously, at this point, FOMO kicks in and traders start buying like there is no tomorrow, pushing the price even higher. That's when the market makers pull a fast one. They basically start selling their positions at these inflated prices, cashing in on the very demand they created. And just like that, they are making bank. But it doesn't stop there. Market makers can also do the opposite, trigger a massive sell-off. Now, this catches overextended traders off guard, causing a ton of stop-loss orders to get hit and positions to get therefore liquidated. It's a wild ride, and it's all in a day's work for these market makers. Now, as far as the supply-demand sequence model goes, I think it's quite versatile and it can be adjusted to work on 1 minute time frames as well as longer ones like 4 hour, daily, weekly, etc. I think that this adaptability suggests that the model, obviously when interpreted accurately, has the potential to generate solid returns over time. Regarding the demand side of the model, you can apply, I think, the same concept use for the supply side. And just a heads up, if you are interested about related supply and demand strategies, be sure to catch this next video. Alright guys, thanks for watching, and as always, hope to catch you all in the next one.